Welcome to the deep dive. You know, when you want to get a handle on what's really moving the financial markets, but without getting totally bogged down in endless articles and jargon.
Yeah, it's a lot to sift through.
Exactly. So that's what we do here. This week, we've been digging through a whole pile of recent financial news, reports from places like CNBC, Forbes, Fox Business, The Independent, Investopedia, The Guardian, NPR, RIA, a whole bunch.
TheSyracuse.com, ABC News, New York Post, AP, PBS, WRAL.
Right. All focusing on the market action around late April 2025.
And our mission, really, is to pull out the key bits, understand what fueled the market's ups and downs.
And maybe get a clearer sense of what's coming next, or at least what the signals are pointing towards.
Precisely. Think of it as your shortcut to understanding a week that saw some, well, pretty significant swings.
Okay, so let's dive right in then, because early April, it really felt like concerns were mounting, especially around trade.
That's definitely where it started. The early part of the month was heavily colored by President Trump's announcement of new tariffs.
And these weren't small tweaks, were they?
No, not at all. We're talking tariffs on goods from quite a few countries, and then this really huge hike specifically for China hitting 145%.
Wow, 145%. That's a big number. And the market noticed, I assume?
Oh, it definitely reacted. The immediate response was negative. The S&P 500, which, is a key gauge of the U.S. market, took a noticeable dip.
Which sectors got hit hardest?
Well, you saw it particularly in areas like tech and manufacturing, companies heavily reliant on, global supply chains and international trade.
And it wasn't just the tariff announcement itself causing the jitters, right? There was more going on.
True. Trump also went on Truth Social, suggesting the economy needed the Fed to cut interest rates to avoid a slowdown.
Plus, he was openly critical of Fed Chair Jerome Powell again. That kind of public commentary has to add to the unease.
Absolutely. I mean, whenever the independence of the Fed chair is questioned publicly like that, it just introduces another layer of uncertainty for investors. Is monetary policy going to be politically influenced? That's the worry.
And this was all happening against a backdrop of sort of weakening global economic forecasts anyway.
Exactly. Around the same time, the IMF revised its global economic growth forecast for 2025 downwards, took it down 0.5 percentage point to 2.8%.
And the U.S. forecast?
They trimmed that too, down to 1.8%. So you had these existing worries about growth, and then boom, significant tariffs, and these comments about the Fed piled on top.
It felt almost inevitable that China would hit back.
And they did. Beijing announced retaliatory tariffs, 125% on American goods.
So tit for tat.
Pretty much. And beyond that, there were reports about China warning South Korea about exports using Chinese rare earths that were heading to U.S. defense firms.
Which just highlights how tangled these supply chains are.
Exactly. And how trade spats can quickly spill over into, wider geopolitical issues.
It really felt like everyone was bracing for this to drag on. I remember seeing predictions of more market falls.
Yeah, some analysts were definitely sounding cautious. Strategists at UBS, for instance, suggested that, depending on how the tariff situation played out, we could see equities fall further.
Did they have a time frame?
They floated the idea of maybe a market bottom around the start of Q3 2025. They were likely modeling the impact on corporate profits, overall economic activity if things didn't cool down.
But wasn't there a counter view? Someone suggesting maybe this was the peak of the tension.
Yes, that's right. Alpine Macro offered a slightly more optimistic take. They suggested the tariff standoff is peaking.
Meaning the worst might be over.
Or at least that the most aggressive moves might be behind us, perhaps anticipating some negotiation or, de-escalation. It just shows how hard it is to predict these things. Different experts weigh the factors differently.
Okay, and while all this was swirling in the stock market, something kind of weird happened with crypto, right?
Yeah.
Bitcoin and gold.
Yeah, that was interesting. For a brief period, amidst the stock market wobbles and a falling U.S. dollar, Bitcoin's monthly average price actually edged above gold's.
That's unusual.
Very. It sparked some chatter about Bitcoin maybe acting like a safe haven, but, gold still holds that traditional status for most investors due to its long history.
Okay, so that sets the scene. Rising trade fears, jittery markets. But then, fast forward to around April 22nd, 23rd, the mood seemed to change quite dramatically. What happened?
Yeah, the narrative took a real turn. We saw President Trump's public statements soften quite a bit.
How so?
Well, the big one was him stating he had no intention of firing Fed Chair Jerome Powell.
Okay. Given his previous criticism, that's significant.
Hugely significant for the markets. They were hanging on every word about the Fed. So hearing that was a clear departure from his earlier tone.
That must have calmed a lot of nerves.
Definitely. And it wasn't just Powell. Treasury Secretary Scott Bessent also came out expecting a de-escalation in the China trade war.
De-escalation, did you give specifics?
He even suggested Trump was willing to substantially cut tariffs. So taken together, these comments signaled a potential shift, maybe a more conciliatory approach on trade and monetary policy.
And the market reaction must have been positive.
Oh, very positive. We saw big rallies. The Dow, the S&P 500, the NASDAQ, all up significantly.
Really shows how sensitive the market was to those specific issues.
Absolutely. It just underlined how closely everyone was tracking those high-level statements on trade and the Fed.
And was this just a U.S. phenomenon, or did it spread?
It went global. Overnight, Asian markets rallied, the Nikkei in Japan, Hang Seng in Hong Kong, Kospi in South Korea.
Europe, too.
Yep, European markets followed suit. The FTSE 100, the DAX, the CAC 40 all saw gains. It was like a synchronized global sigh of relief.
So this rebound basically clawed back some of the losses from the previous uncertainty.
Pretty much. It was a much-needed lift after that period, dominated by the tariff fears. And there was other potentially positive news filtering through, too.
Like what?
White House Press Secretary Caroline Leavitt announced the U.S. had received 18 trade deal proposals, which suggests, active engagement behind the scenes.
Any hints of new partnerships?
Well, Vice President J.D. Vance was in India, making positive noises about boosting U.S.-India trade cooperation.
Diversification, maybe.
Potentially. Hinting at broadening trade relationships, perhaps lessening the reliance on or impact of the China situation.
Okay, let's pivot a bit. A company that always seems to be in the news. Tesla and Elon Musk. What was their story during all this market shop?
Well, Tesla's Q1 earnings actually came in below expectations. Revenue was down about 9%, and net income took a big hit, down 71%.
Ouch. And wasn't there something about public perception, too?
Yeah, some surveys around that time indicated a bit of a negative trend in public perception for both the company and Musk himself.
Okay, so weaker earnings, maybe some image issues. Normally, you wouldn't expect the stock to rally on that news, but it did, right?
It did. And this is where it gets kind of fascinating, showing how unconventional stock drivers can be sometimes.
What was the trigger?
Despite the earnings miss and those surveys, Tesla's stock jumped pretty sharply after Musk announced he'd be spending significantly less time at DOGE, the Department of Government Efficiency.
Wait, less time at his government role made Tesla's stock go up.
That's how the market seemed to read it. The interpretation was, okay, he's refocusing on Tesla, and investors apparently loved that idea.
Wow. Shows how much weight the market puts on his perceived focus, sometimes even more than the bottom line numbers.
It certainly seems that way sometimes, and the good news for Tesla stock didn't stop there.
Oh, what else?
It got another boost later in the week on news. The White House was planning to loosen rules around autonomous vehicles.
Oh, okay. That's obviously seen as a big potential plus for Tesla's future plans.
Exactly. A potential regulatory tailwind for their autonomous driving ambitions.
So, summing up Tesla's week, despite a rough earnings report, Musk shifting focus plus potential regulatory help equals
their best week in the market since November 2024. The stock gained something like 18%. It just highlights the complex mix of factors driving individual stocks.
Definitely. Okay, moving beyond the big headlines of trade and Tesla, what else was moving the markets? Any other interesting currents or company news?
We did see some action in currencies. As the U.S. dollar weakened a bit during the volatility, one particular safe haven currency strengthened.
And the ETF tracking it.
Went up too, yeah. Suggests some investors were definitely seeking shelter in perceived lower risk assets during that uncertainty.
What about different market sectors? Any standouts, good or bad?
Well, it's interesting. Even with the recent tech rally, Barclays pointed out that year-to-date, the tech sector was still actually lagging the broader market.
So catching up, but still behind overall for the year.
Sort of, yeah. Still making up lost ground. On the flip side, material stocks kind of underperformed towards the end of the week.
Any reason why?
Partly dragged down by Eastman Chemical. They specifically mentioned tariff uncertainty and messing with their ability to give future financial guidance.
Right, so even with the main indexes up, specific sectors still felt the pinch.
Yeah.
What about other individual earnings calls? Heard Alphabet did well.
Yes, Alphabet, Google's parent, had strong earnings, mostly driven by their ad business, especially the AI-powered search stuff.
Stock reacted well.
It did, yeah. Stock went up. Lots of analysts raised their price targets. But it wasn't all sunshine.
Who else reported?
Intel. They put out weaker than expected guidance for the next quarter. Their stock dropped.
Okay.
And T-Mobile also saw its stock dip. They reported slower subscriber growth than hoped for, and also flagged concerns about tariffs potentially hitting mobile phone costs.
So really a mixed bag at the company level,
Yeah.
not just macro driving everything.
Exactly. We also saw Charter Communications, big cable internet provider, their stock jumped after good earnings.
But then others were pulling back.
Yeah, Skechers, the shoe company, actually withdrew its financial guidance for 2025 entirely, cited the global trade policy uncertainty.
Shows how widespread those macro worries are.
Absolutely. And Southwest Airlines also pulled some financial forecasts, pointing to an uncertain economic outlook in general.
Any interesting technical signals from the market itself? Indicators flashing.
Well, we saw something called the strongest breadth thrust since November 2023.
Breadth thrust, meaning
Market breadth is basically how many stocks are participating in a move. A thrust means a whole lot of stocks moved up together strongly, suggests strong momentum.
is that usually a good sign for the future?
Historically, the short-term results after one of these are kind of mixed, so it's interesting, but maybe not a slam dunk predictor.
Anything else? Dollar? Gold?
Yeah, the US dollar index firmed up a little towards the week's end after being weaker earlier, and gold, after hitting a high point, actually fell back.
Suggesting maybe less demand for safe havens as the week closed?
Potentially a shift in that safe haven demand, maybe.
Seems like so many competing signals. What about the average person? Consumer sentiment? Did all this volatility have an impact?
It appears so. A survey out during this period showed a pretty significant drop in consumer sentiment.
That's worrying, right? Could affect spending down the line.
It's definitely something to watch. Weaker consumer confidence isn't usually a great sign for future economic activity.
And one last thing I saw mentioned foreign investors selling U.S. assets.
That's right. Goldman Sachs noted that foreign investors actually offloaded a pretty sizable chunk of their U.S. asset holdings during this period.
Is that a major risk?
Well, given how much foreign investors hold, if that trend were to pick up steam, it could potentially put pressure on equity prices. Something to keep an eye on.
Okay, so let's try and wrap this all up. Bringing everything together, what's the overall takeaway mood from this period? Where might things be heading?
Well, look, the week definitely ended on a more positive footing. Major indexes were up, clawing back those earlier losses. That's the headline.
But there's always a but, isn't there?
But yeah, the underlying volatility, the uncertainty around trade, around the economy, that hasn't just vanished. It's still very much there.
So the rebound doesn't necessarily mean clear skies ahead.
That's a really key point. Deutsche Bank even put out a note suggesting the damage done to the idea of U.S. exceptionalism in the global economy might be kind of long-lasting, even with this recovery bounce.
And analysts are still cautious about earnings.
On average, yeah. We saw analysts trimming their earnings expectations for the rest of 2025. Still a fair bit of caution out there.
Though some were more upbeat. Didn't Citi think stocks would keep climbing?
Yes, you definitely have differing views. Citi felt that now the tariff news had stabilized somewhat, equities should manage to sort of grind higher.
So what's next? What are people watching now?
Big focus is shifting to upcoming earnings, especially from the big tech hyperscalers like Microsoft and Amazon. Their results carry a lot of weight and could give more clues about the broader economic health.
Makes sense. Sounds like navigating this still requires care.
Absolutely. As one financial planner put it, patience and a disciplined approach are pretty crucial for investors in times like these.
Okay, so summing up our deep dive for late April 2025, the market showed itself incredibly sensitive to words, especially on trade and Fed policy. Sentiment flipped fast.
Very reactive.
Individual company stories, particularly Tesla, also clearly mattered a lot. But we're still getting these mixed signals from the broader economy.
Yeah, the week ended strong on the surface. Major indexes recovered. But those fundamental concerns about trade, inflation, growth, they're still hanging in the air.
Exactly. Which leads me to a final thought for you, our listener, to maybe chew on.
Go on.
Considering how quickly and dramatically market sentiment shifted, based mostly on, well, pronouncements and perceived policy changes, how much do you think actual hard economic data is driving things right now versus the market's interpretation of what policymakers might do next?
That's a fascinating question. How much is perception versus reality in the current market?
Something to definitely keep in mind as you follow what happens next.
Thanks for taking this deep dive with us.
See you next time.